So let's talk about banks. And the reason why I want to talk about banks is because they don't work like other companies out there. Um, their world is completely different, and frankly, the way that you value them has to be different as well because of that. Now, the reason why is because cash flow doesn't mean the same thing for a bank that it does for any other institution out there. What it is it's just the stream of interest payments minus whatever, right? Minus whatever expenses. That's what that's what cash flow is for a bank. Um, and the thing is that cash isn't the same thing for a bank, right? For a bank, cash is raw material. Just like uh, a big block of iron would be, uh, or iron ore would be for a smelting company, right? That's what cash is to a bank and a financial institution. So it doesn't work, right? You're you have to value it with cash, but then it's different, and it creates a big headache. So I wanted to explain this to you guys because I think this is important. For a bank, if you're going to invest in a bank, you have to understand what you're actually getting, right? And I think that if you look at the finances of a credit union, you will understand what you're getting when you invest in a bank. It's a complete, those two things, putting money into a credit union and investing in a bank, actually end up being pretty much the same thing, at least in terms of the bank's balance sheet. Um, it looks exactly the same. So the question then becomes, what do you do with that, right? And the thing is that with a credit union, the money you put into it becomes an ownership interest in the credit union, right? And that ownership interest is valued at exactly how much money you have in the credit union. Simple, right? And it shows up on the equity side of the credit union's balance sheet. And that's it. That is an investment into a credit union. Well, when you put money into your credit union, you're buying equity in the credit union. Period, right? And so what happens when you buy stock in a bank? You are buying the equity of the bank. There's a slight wrinkle though, right? And the wrinkle is that the bank, the price of that equity shifts up and down, right? And because it shifts up and down, you kind of have to be a good judge of the bank, right? And the easiest way to do that is to actually calculate how much a share of the bank is worth in dollars, right? Get the book value of the bank and compare that to the price that you're paying. Because here's the thing. I told you, it's exactly like putting money into a credit union, right? But in a credit union, you get dollar for dollar of value. In a bank, the shares are publicly traded and you don't get dollar for dollar when you're buying your shares in the bank. You could get dollar for dollar. You could pay $1 and a nickel for every dollar of value you get in the bank, right? Essentially, you're just putting money on deposit in the bank. That's how you're capitalizing the bank, is you're putting the money on deposit in the bank. But that money that you're putting into the bank, it becomes this kind of nebulous thing. You aren't sure that you're actually going to be able to pull that money back out of the bank, right? Because there's no guarantee on withdrawals like there is with a credit union. But you're in the same position that you would be if you put your money in a credit union. So what do you need to do here? This is the key with a bank. If you can buy a share in the bank for less than the dollar value that's available in the bank, then you should buy the bank, right? And the reason why is because if you're paying 50 cents for a dollar of value, congratulations, you've doubled your money, right? There are other considerations that you want to take into account, right? For example, how efficient is this bank, right? For every dollar of revenue that the bank generates, how much of that does it give back out in expenses, right? How efficiently is the bank using the revenue that they're generating on your assets? That is the number one question after you've purchased the bank, right? Because a bank that has a very small expense compared to its revenue is going to generate cash, and that cash is going to be paid back in terms of interest to the creditors of the bank and the equity holders of the bank. And so you want the bank to have to keep as much of the cash that it generates as possible. That's it. That's the name of the game with a bank, right? Buy it for what it's less than it's worth. Buy it for less than it's worth. Hold on to it if the bank is generating good profits on that money. That's it. That's all that there is to a bank. In that case, what you should do is you consider the bank as a savings account. That's the way I view it, right? Because it's equivalent to getting a savings account in a credit union. That's it, right? The only difference is somebody was stupid enough to sell you their bank account for, $75 when there's $100 in it. That's it. That's it. That is it with a bank, right? If you look at those two things and those two things alone, then great. The only other thing that I would say that might throw a wrinkle in there is if the book value contains a lot of intangibles. Then you might want to go with the tangible book value. That would be things like the loans, the branches, the buildings that the bank owns. All of that sort of stuff would be the tangible things that the bank owns. Again, like I said, loans, notes, securities, that sort of thing as well. But if they're holding a lot of their assets in terms of branding, right? Or other weird intangibles, patents. Why would a bank need that many patents, right? If they're holding on to those things in that way, then the bank's book value is probably not a good indication for what it's actually worth, in which case you'd probably want to use the tangible book value of the bank instead. But that's it, right? The valuing banks is very, very simple. Keep watching, subscribe, hit the notification bell, because what I'm going to do is this week I'm going to be adding a valuation of Citibank. It's a bank that I've been watching for a while, and I'm going to talk a little bit about these things, and we're going to go through the entire valuation process with Citibank. And then we're going to talk about some of the issues that are coming up and whether or not that might be a good buy for you. So if you want to hear that, hit the subscribe button, hit the notification bell, and we'll talk to you later this week. Until then, stay rational, my friends.